All right, welcome. Today we're going to tackle a topic that's super important for any student of business or finance: how interest income is taxed. And here's the kicker. It's not just about what you earn, but when the government says you've earned it. Okay, so here's what we've got on tap. We're going to kick things off with why timing is, well, everything. Then we'll look at the super strict tax rules for corporations and compare them to the choices you get as an individual. After that, we'll dip into how this all works for global investments and wrap up with how you can use smart deductions to keep more of your money.
All right, first things first. Let's make sure we're all on the same page. What exactly is interest income?
So on the surface, this seems super simple, right? It's the money you get for lending out your money. But here's where it gets tricky. The part that really trips people up isn't what you earn, it's when you have to tell the tax man about it.
So chew on this for a second. This one single question has a huge impact on your cash flow and the real after-tax return on your investment. And the answer? Well, it's totally different depending on whether you're a person or a company.
Let's kick things off with a business scenario. Let's say we've got a company that's lending out some of its capital.
So in this case, the company isn't going to see a single penny of that interest for 2 whole years. But when it comes to corporations, the tax rules are, well, they're black and white, no exceptions. So how does this actually work? Well, companies have to use what's called the accrual method. And that means they have to report interest income every single day as it's earned, even if the cash is nowhere in sight. It reflects what they're earning in real time, whether they can spend it yet or not. And this chart really spells it out. You can see for those 3 months the loan was out in year 1, it earned $250. And even though the company hasn't touched a single dollar of it, they have to report that $250 as income and pay tax on it for year 1. For a business, that can be a big deal for cash flow.
Okay, so that's the corporate world. Pretty rigid, right? Now let's flip the script and look at how this works for an individual investor. This is where things get way more interesting, because you actually have some choices.
So unlike a corporation that's totally locked into that daily accrual method, you as an individual technically get to pick from 3 different methods. But, and this is a big but, there's a catch. You could go with the cash method. Super simple. You only report it when the money's in your hand. Or the receivable method. But look, for any investment that's longer than a year, where they don't pay you interest every year, there's this really important rule that trumps everything else. So let's look at another situation. An individual loans out $100,000. If you just went by the cash or receivable methods, you'd think, great, no taxes till year 3. But that's not how it works. That anniversary day accrual method completely changes the game. Okay, so check out this timeline. This is the key takeaway here. Even though the loan starts on February 1st of year 1 and you get 0 cash that year, you can't just ignore it. That first anniversary, February 1st of year 2, falls in the 2nd tax year. So on your year 2 tax return, bam, you have to report that entire first year of interest, all $12,000 of it. You get to defer the tax, yeah, but only for a little while. All right, so these timing rules aren't just for simple loans. They get even more important when you start looking at more complex stuff, like, say, investments you might have in other countries. Okay, when you're earning interest from another country, you've got to report it in Canadian dollars. But here's the real danger, the big warning sign on the slide. Double taxation. Imagine this. You have to report your accrued interest here in Canada in 1 year, but the foreign government doesn't actually take their tax cut until the next year when you get paid. If that happens, you could lose out on your foreign tax credit. Getting the timing right is absolutely crucial. You know, life insurance isn't always just life insurance. Sometimes it's an investment vehicle with a savings part that earns interest. And the tax rules here are, you guessed it, super specific. For most policies, you're reporting earnings every year. But some special exempt policies let you put off paying taxes on that growth for a long time. The bottom line, you absolutely have to know the tax rules for a policy before you buy it. Okay, so we've figured out when to report income. Now for the fun part, how to legally pay less tax on it. And that all comes down to knowing what expenses you can deduct. This is probably one of the most fundamental ideas in tax. You're not taxed on everything you bring in, you're taxed on your profit. That means revenue minus expenses. So the big question is, what counts as an expense? And there are quite a few things you can deduct. For instance, if you borrow money to make an investment, the interest you pay on that loan, usually deductible. Fees for getting investment advice, deductible. Even some of the legal fees you might pay to get a loan can be written off, though you have to spread that out over 5 years. The key is to track everything, because every legitimate expense lowers your tax bill. So, if we boil it all down, what's the one big thing to remember? It's this. For taxes, corporations are on a daily clock. They report interest as it's earned every single day. But individuals with those multi-year investments, you're on an annual clock, and it's all tied to that anniversary date.
So, knowing all this, it's not just theory, right? This is the first most important step to making smarter decisions with your money. It helps you manage your cash and build a better financial plan. So the question you have to ask yourself is this: are my investments set up to play by these rules, or am I playing against them?